So the broader question is that the portfolio is primarily invested in equities, but can you talk about other asset classes like crypto or bonds or gold, particularly people are very interested in these days? Should we be thinking about that? Are you thinking about that?
Yeah, that's a really good question. I do think, so we are primarily invested in equities, but we really are invested in the asset class that that grows the fastest. So in fact, Jeremy Siegel, who's a professor at Wharton, put together about 200 years of data. That's a great question. Let me see if I have in the appendix here, I'm gonna see if I can pull up a little slide. I'm going to share the screen again for a moment and try to bring us to, yeah, here's a slide that I can share. So this is, oh, my apologies. I thought I was going to go right there. So this is, can you see this, Danielle?
Yes.
Perfect. So this is a diagram that was put together by Jeremy Siegel in his book, Stocks for the Long Run. He's the, Wharton's an excellent financial school, probably within the top 3 probably in the world. And he's the chair there. He put together 200 years of data and basically analyzed it extensively in his book, Stocks for the Long Run. And you can see here, if you put $1 into all these different asset classes in 1800, what's going to happen? So if you put $1 in dollars, it turned into 6 cents. And this is after inflation, right? So inflation just took out all your money. So the most risky asset is cash. Gold over 200 years went to $2. So it went from 1 to 2. T-bills went to $300 and bonds went to $1,000. So we went from $1 to $1,000 with bonds. And then stocks went to $755,000. So it's like not even comparable, right? This is on a log scale. Otherwise the stocks would be off this chart literally. And so this is mainly the reason. I mean, we're focused on the long run. I'm not focused on 200 years, but all these dips and things along the way, I mean, you can probably sort of see here, oh yeah, there was a Great Depression in there. It kind of lasted for certainly from 2009 to 19, or from 29 to 1933. You can see all these dips, but it's actually pretty remarkable. And so what he found is that over in like 10-year periods, if you look at these rolling averages, the rate of return is 6.8% plus inflation. So after inflation, you get about 6.8%. And that's been remarkably stable over many, many years. So, and if you think about it, these are stocks or businesses. So businesses are designed, I'll stop sharing this now. I just kind of want to throw that out. But businesses are designed to earn profit. That's the whole point. And you have ones that make a lot of profit, and you have others that don't make profit. But that's literally the function of a corporation. So that's kind of why you'd want your money there. If you bought a bunch of gold, and look, you want some diversification, great, go buy some gold. We don't own gold. I saw that Buffett bought a little gold, which is interesting. But you don't really, gold doesn't actually make money. It just sort of sits there. So you can have gold, and then the environment around will speculate on the price of that gold. And maybe maybe the dollar is very strong. The dollar is very strong in this world. If anybody's gone overseas in the last couple of years, it's like, it's great. But maybe that adjusts down a little bit, and then maybe gold goes up against the dollar. And so, but that's still speculating. It's not like gold is producing more gold. Whereas if a company's compounding their capital and then reinvesting that, that capital is, those dollars are making dollars, and then those dollars are making dollars. And that's really where you want to be. Bonds, I will share with you all. I strongly encourage, especially even the ones that are, older. It's like bonds are, we've had a 40-year run where bonds have done really well. And so it's sort of been, it's like brainwashed 2 generations. Interest rates have just come down since the 80s. We have hit 0, okay? So, and as long, you know, over time, interest rates will rise. And when interest rates rise, bond prices fall. So we are in an environment now where you basically top tick your bonds. You're at the top, so sell them. I think bonds are a very unnecessary risk to be having in your portfolio right now, because if rates do jump, those bonds start to fall, especially any sort of longer term bonds. Also things, you know, municipalities and things that issue munis, so people like them for the tax benefits, but they forget that if a municipality has trouble, they won't pay their bonds. So there's actually risk of default in bonds as well. So bonds are a little, I don't think bonds are a wise place to have long-term capital right now. I think that inflation, by the way, if you look at bonds, our treasuries are pay, you know, 0 to 1%, and the Fed's target inflation is 2%. It's sort of like cash. You lose money every year in terms of purchasing power. And then finally, cryptocurrency. Look, I'm not totally opposed to diversification. The value community in general sort of shuns cryptocurrency because it's a speculative asset without any real tangible value. But maybe it becomes something a little bit in the future. Maybe it becomes more something that you could transact in. So we don't own it. I don't think we would ever own it in the portfolio for any reason. But if you want to own a little bit, sure, it's kind of like maybe going to Vegas or something. You just go buy some Ethereum and see what happens, and that's fine. But I don't think of owning a cryptocurrency as an investment, and that's why we're primarily in equities.